Hey, how you doing? Emmett Dempsey, Treasure Coast Mortgage. Today's video is going to be an in-depth dive into the VA loan. It's going to be your guide for 2021, start to finish, all the highlights of the VA loan. And the VA loan is very special to me personally because I'm a veteran and I have a VA loan myself. I love helping other veterans with their VA loans. And this guide will help answer some frequently asked questions about the VA loan from start to finish. So let's go ahead and take a look at the VA loan. Okay. VA loan requirements 2021 complete guide. Again, here's Captain Dempsey back in the day, just quite a few years ago, airborne, rigger. And let's move along. So VA loan highlights. So what makes up the VA loan? It allows eligible veterans and others to buy a home with 100% financing, which is awesome. Okay, it allows you to refinance, cash out up to 100% cash out. I know I just did one myself, so it's definitely a great loan. There's no mortgage insurance, which is huge, and I'm going to show you why that's huge compared to other different types of loans. Very low rates due to the government guarantee. Has a funding fee, which is not so great, and as well as refinance and streamline programs available called the IRL, Interest Rate Reduction Refinance Loan. Okay. And currently it's about 10% of the mortgage market, which is expanding. We want to make sure all veterans take advantage of their VA loan benefits. Okay, the history of the VA loan. All right, signed into law by FDR in 1944, even before World War II even ended. It was part of the original Servicemen's Readjustment Act, better known as the GI Bill of Rights. It was meant for those who fought in World War II to come back to the United States and to be even with their civilian counterparts as far as building credit, getting home ownership, things of that nature. Okay, at the outset in 1944, the VA guarantee was about $2,000 with a 50% guarantee. But the average home price back then was about $8,600. So don't we wish that homes were $8,600, but not so much. Okay. Initially, the program was only for World War II veterans, and they only had 5 years to use it. And then over the years, with different conflicts in Korea, Vietnam, Persian Gulf, etc., it resulted in further congressional acts over the years, over the decades, in order to expand to the VA program that we have today. Okay. Who qualifies for a VA loan? Okay, first, a veteran who is not dishonorably discharged. Okay, so the guys in A Few Good Men, they couldn't get a VA loan. Okay, serve 90 consecutive days on active duty in wartime, or serve 181 consecutive days during peacetime. Or you can serve 6 years in the National Guard or Reserves, or be the surviving spouse of a service member who died while serving or have a service-connected disability. Okay. Entitlement, DD-214, COE, oh my. So let's go ahead and take a look at that. You start with your DD-214, Release of Discharge Active Duty. And for those of you that know, most veterans know what this document is. Here is my DD-214. I redacted that. But basically this is what it looks like. You're going to come down here to the character of service. Honorable discharge, release from active duty. This is service, the number 2 document, because a lot of times you get copy number 1. This is copy number 2. You want your service document that shows the character of service in order to get your COE. Okay, so you're going to need that. And what happens is you'll get this document. Here's the COE I got for my last refi. The Army funding fee, status non-exempt. Now, Veterans Basic Entitlement is $36,000, and we're going to go over all that stuff right here in a minute. Okay, veteran must pay a subsequent funding fee. And here is a COE of a redacted, client of mine. You can see that there's prior loans charged to his entitlement. We're going to go over all that factors in a minute. It basically says the veteran's basic entitlement is 0. We'll go over that in a minute. But here's exempt with monthly award. So basically, what I do, I usually pull these COEs for my clients so they don't have to go to the VA or anything like that. But this is just what these documents look like in case you've never seen them before. Your DD-214 and your COE. Okay, let's go back here. Okay, you get to the COE for your mortgage broker. That's me. We can pull it for you. Okay, the program is administered by the Department of Veterans Affairs. However, they do not lend money. Okay, the VA does not, have a bank. What happens is, different banks loan to veterans, with a guarantee by the VA. What is the VA guarantees a portion of the loan against default risk. So it allows lenders to lend at attractive rates because they're protected from their losses. So they're allowed to offer basically with no down payment with a 25% guarantee. The guarantee is called a VA entitlement. Like I said, over the years it's changed. It was 50% when it started. Now it's $36,000 your basic entitlement, as I showed you on your COE, and 25% of the loan amount up to the conforming loan limit. So effectively, it's basically like making a 25% down payment, whereas a conventional loan with no mortgage insurance is 20% down, whereas a VA loan, effectively, where banks look at it as a 25% down loan, because to them, they're going to get their 25% no matter what. So they're going to have that cushion of equity, so they're allowed to lower the risk and offer these loans and offer the mortgage liquidity to make the VA program work. Okay, entitlement loan limits. Wait a minute, $36,000, is that the only loan I can get? No, that's just the way the VA, and basically if you figure 25% and 4 times 4 divided by 4, that's kind of how I always liken the VA program. Okay, no, that's the basic entitlement, and VA loans have secondary or bonus entitlement, which is tied to the conforming loan limit. We're going to go over that in a second. Okay, the basic plus your secondary equals your full entitlement. And then, so whenever you say, well, my basic entitlement is $36,000 plus whatever the secondary entitlement is, depending on the conforming loan limit, equals your full entitlement. Okay, currently the conforming loan limit for 2021 is $548,250. It's been gone up over the last few years. I remember, I've been doing loans since 2007, and it's been $417,000 for years and years and years, and then it finally started to thaw out and raise to meet the market. Okay. To calculate the full entitlement, basically you divide the current conforming loan limit by 4. All right. So here's that calculation. It's $548,250 divided by 4, $137,063. So you might see these numbers, thrown around there. So that's how we arrive at your entitlement. And I'm going to go over, further on in the video about about that. Also that, just want to stop, go ahead and like this video. It really helps the YouTube algorithm find my videos. And if you haven't already, go ahead and subscribe. All right, let's go and take about the loan limits and the closing cost. Okay, VA loans have a no loan limit. That was recently changed. I think it was the Navy Blue Water Act, something along those lines, where effectively you have full entitlement, there's no loan limit, even with no down payment. So that's a huge benefit. But you must have full entitlement to go over the conforming loan limit, whatever it is. However, lenders, I consider anything above the conforming loan limit a jumbo loan, and they have pricing add-ons or overlays, basically minimum FICO scores, might make it a little bit harder because it is a lot of money. So even though it's insured, it's still a big loan that they're making. Okay, and then there's certain high-cost counties. I know out in California, Virginia, certain high-cost counties, up to 822,375 is their limit. There's no down payment required, but it can affect your funding fee. And closing costs are standard for the state. Even though it's a zero down loan, there is cash to close with closing costs and prepaids. I know in the state of Florida, since there's no state income tax, you have to pay the taxes, the doc stamps for every mortgage has them here in Florida. So there are closing costs to be paid, even though the down payment is zero, but your cash to close consists of your down payment, closing costs, and prepaids. All right, let's go and talk about the funding fee. The fee goes to the Department of Veteran Affairs, sorry, it's a typo, to help cover losses from the entire program. So the funding fee goes to the VA to help cushion default for the entire program throughout the country. Okay, the fee is required unless the veteran has a 10% or more service-connected disability, but you can also finance this fee. So it's not like you're paying it out of your pocket. Okay, and here is the funding fee chart. And it all depends on how many times you use your VA loan. Because if you use it more than once, then you're going to pay what's called a subsequent use funding fee. So if you put nothing down, your fee is 2.3%. Okay, if you put down 5% or more, that fee lowers to 1.65, and then 10% or more, 1.4. So if you don't want to pay as much of the funding fee, and if you have some cash to put down, so go ahead and we'll go ahead and run numbers and see what it is. Whether it makes sense, but the more you put down, the less your funding fee. Okay, what are the credit requirements? Basically, VA in 26-7, which is the document that it's governed by, has no debt minimum requirement. And no minimum FICO. Generally, the minimum FICO is 500, and as a mortgage broker, I have certain lenders that will go down to 500. A lot of your mortgage banks, they won't go below 620 or even 640. So that's kind of where their cutoffs are. As a mortgage broker, I can definitely go lower than that. Okay, so one of the most lenient types of the major loans. It's huge, but your best rates are generally for 640 or above. Okay. Credit event wait times. You don't want to be this guy with an empty wallet. So that folks going through the housing crash. They had to have foreclosures and wait times. And here's the credit event wait times for the VA. Foreclosures about 2 years. Chapter 711 bankruptcies 2 years. Chapter 13 1 year. Short sales 2 years. Deed in lieu foreclosures 2 years. And the cure default as well as 2 years. So you might see guidelines out there about extenuating circumstances. I have never seen an underwriter accept them ever. So they even say with job loss, but like with 2008 and things like that, even 2020, job loss happened to everybody. I have never seen an underwriter ever given the leeway to approve it. So I just don't even go down that road. I would just ignore the extenuating circumstances. But even so, the VA wait times are about a year shorter than your FHAs. Usually FHAs will say 3 years, whereas conventional foreclosure is like 7 years. So it's definitely easier to qualify. Okay. All right, student loans. This is a big issue. I know there's recently some good guideline changes for FHA, and I did a student loan video about that. But VA is pretty lenient on the way that they account for them. We still have to account for deferred student loans, just like conventional FHA, whatnot. But however, VA loans account for it differently. If you have written evidence that but the loan's going to be deferred for over 12 months, monthly payment is old school, like just ignored, like the way all deferred student loans used to be. But if not, then we calculate the loan at 5% of the loan balance divided by 12. Even so, let's say a $25,000 balance times 5% divided by 12, it's $104.17 a month. Still better than 1% conventional or 0.5% Freddie, and I think FHA just went down to 0.5% as well. But it's still your VA again. Wins out in the way they calculate student loans. Okay, interest rates. The interest rates on the VA loan are very, very attractive because of the VA entitlement and the guarantee. Because, like I said, it's akin to putting down 25% in the lender's eyes. Since the VA loan is guaranteed by the federal government, rates are extremely attractive and they're lower than conventional loans. I'm going to show that in a minute. They're similar to the FHA rates. However, there's no MI like FHA has, and I'm going to show you, how that really plays into play in a minute. Brokers, generally have better rates. Lenders can overcharge. There's been a lot of controversy and a lot of prosecutions about lenders overcharging, overcharging veterans. Definitely need to shop around. Like your major, you see them on TV. Your veteran lenders. Do your shopping. Even your major banks on your military base might not always be the best. Definitely shop around, get a lock loan estimate, so you can definitely look. Those loans are more because the loans are highly profitable for mortgage lenders, and some have been prosecuted for abuses. So we definitely make sure our veterans are taken care of. That's why I love working with veterans to make sure that they're taken care of and they're getting the best possible deal that they possibly can. So they can do that. Okay, get a loan estimate to compare fees. Worst case is a fee sheet. The best is get a loan estimate. You can compare and contrast, and we can see what you can match or beat what you're being offered. Okay, all right. Property requirements. Basically, you must be owner occupied within 6 months. Like you can't buy an investment property or a vacation house with a VA loan. You have to buy the house you're going to live in. Okay. But you can buy a 1 to 4 unit building because technically single family homes are 1 to 4 units. They're not just one houses. So you can buy a fourplex, triplex. I haven't seen too many here in Florida, but I'm sure other states have more. If you can buy a duplex, live in one side, that's huge. And then you can kind of piggyback off of that and house hack. Okay. And the standard for VA is safe, sound, and sanitary. It depends on the property's location, legal considerations. Now, I know there's some areas of the country that don't have, central air, so they take into consideration. It's like, okay, not every house has to have, this cookie cutter. It depends on where it's at. Okay, street access and who does the maintenance. And that's a big thing. Sometimes on dirt roads, they make sure there's maintenance agreements to make sure that those roads are usable. And another quirk about VA is that you have to have a termite report done, or wood-destroying organisms is required on every VA loan, and on a purchase that the seller has to pay for it. Don't ask me why, but that's just one of the quirks about a VA loan. that's written into the guidelines have to have a WDO report. All right, the appraisals. VA appraisals are handled through the VA portal. There's a VA roster of appraisers. And they're assigned by them when you request an appraisal, it just does a round robin, and they get out there pretty quickly. You know, in our market right now is pretty busy. Appraisers in general are busy, but VA turns them around, and they have a certain standard that they have to get it back in time. Okay. They're part of the same process as conventional FHA appraisal. They just go out, look at recent sales within tight radius. The appraisal process is still the same. It's a roster of appraisals. You know, but one benefit of the VA loan from a realtor side is what's called Tidewater. And Tidewater is a provision when the appraiser says, "Look, I'm not going to meet this purchase price. So you realtors and folks need to give me some good comps that I might have missed. I'm going to give you a chance." To find me some comps to support your sales price, and then before I issue my final value. Okay, so they go forth, they send it up, and then and once the appraiser is done with his report, he'll go ahead and issue it. You know, and all parties provide supporting comps. Okay, the appraiser issues a notice of value. The appraiser issues the appraised value, and then the appraisal goes to the underwriter, and then a government underwriter will issue what's called an NOV, or notice of value. The underwriter has to agree with the appraiser. Because if they disagree, then the NOV won't be issued. One other thing I didn't put on here is that you can also do a value reconsideration request, and I've been winning these with the VA. So if we feel it's kind of almost Tidewater Part 2. So I had one where Tidewater was called. Appraiser didn't care. He just issued his value. I went to the VA service center. It's like, here's my supporting comps, and we won. So VA, I've won more appraisal battles with VA than any other loan. Okay. All right. Next, employment. Again, 2-year job history, just like most mortgages, they will consider less than 2 years. They generally, for any new employment, they want you to have at least 30 days of pay stubs. In order to be established at your new job, and they're fairly lenient when it comes to conventional. Like I said, the VA guidelines are fairly leaning towards the veteran for approval versus denial. Okay, all right, debt to income ratio. This is one of the number one things that all mortgages are based off of. Okay, the acceptable max for VA on paper is 41%. Okay. However, debt to income above 41% can be approved with good residual income. Okay, DTIs over 60% can be approved depending on the residual income and other factors. And we're going to talk about residual income in a second. And what is residual income? It's the amount of discretionary income left over after all major expenses are paid. VA also counts child care expenses under 13. If you have a large daycare bill, it can affect your DTI. And that's another unique feature that's not so great about VA loans is that there's a child care letter you have to sign to say how much your child care expenses are, and then it counts against you. All right. The residual income requirement. The requirement depends on what part of the country you live in. There's a under 80,000 chart, but all loans basically these days are over 80,000, since the chart we'll use. Depends on the size of your family here. And depends on where you live. So you have a family of 3 in the South, it's 889. It's not a huge hurdle to meet, but that's what we use for residual income. So in order to go above 41%, you have to 120% of the residual income in order to hit that. Okay. What is going on? Oh, crap. Okay. Okay, sorry, I'm trying to get back on track. Okay, so all right, so residual income, and the home you're buying factors into residual income as well. All right, so we use the utility expense times 0.14 for the home square footage. And let's say for a 2,000 square foot home, the charge is $280. So they factor all these items into the residual income. So in order for you to get a higher debt to income, and the VA loan can go up to 60%. I've had some VA loans, 65% back end DTI, but they had really good, strong residual income in order to meet that. Okay, manual underwriting. So another thing too is like what I've been talking about is it's called automated underwriting through Fannie Mae, uses DU, DO, and Freddie Mac uses LP. or LPA rather. So what happens if you get approved eligible or LPA accept? However, so if sometimes they're on the bubble, and what if they get a refer eligible? So it's not just a flat out denial, like a refer or caution. So VA allows a what's called a manual underwrite. So they look at your income, your debt to income, and that government underwriter can approve your loan and not have an automated approval, which is a pretty cool rule. And then the guidelines basically just instruct underwriters to do their best to find a way to approve the loan, and usually the lenders will write these guidelines about what they'll accept. Okay, all right, seller credits. Even though there's no down payment is required, there's still costs to pay, like closing costs and prepaid items. Okay, and the VA rules have a 4% of the sales price as a maximum. That's in addition to the normal discount points, and so the max is not 4%; it's 4% plus whatever's the normal discount points and the buyer's loan-related closing costs. So you can compare that to conventional 3% and FHA is 6%. However, the VA sellers can even pay buyers' debts to help them qualify. So, so you can pay off a car, with a concession in order to qualify. So you can do that as well. But however, in 2021, I know in my market, seller concessions are not as prevalent as they were. And if I have a couple of VA loans where the buyer pays all the closing costs and the concessions were only to to help pay what they're already paying. So they're not as common as they were in years past when we have a softer buyer's market. But as the market shifts, that might be more prevalent. All right, special feature, 2 VA loans. So let's go ahead and take a look at this here. And I kind of hinted at this in a minute. And I did a video, and it's pretty popular. Folks have been calling about it. Your next house has to be owner occupied. You check your certificate of eligibility to see charge entitlement, and depending on the county loan limit, we can determine the max price with no down payment. Okay, so let's go take a look at this example here. All right, so I showed you a COE of this guy here. 73,375. So let's just say 269,069. So the current home, let's just say 73,375. And this is Excel. I use this for everything. So here's your basic entitlement, 36,101,163, and I backed into that. So I just changed the loan limit and then just divided by 4, minus 36, and that's how you arrive at secondary entitlement. So, and then it uses this. So for the one I just showed you, here's a COE of this client here, 73,375, and basically he has remaining entitlement of 63 times 4. You can buy the next house for $254,750. Okay, but say you wanted to buy a $375,000 house. Okay, so here's that. So you have to make an 8% down payment. Okay, so this might not the best scenario, but let's just say for 3.5% FHA, but less down payment, but you also have the mortgage insurance as well as 5% conventional, or whatnot. So let's just you can kind of play with these numbers here. So let's just say you bought a $200,000 house, and then you want to buy a $350,000 house. So it makes sense. Basically, you got to make a $400 down payment. So that's not bad. But again, compared to FHA, it's always 3.5%. Conventional, 5% down, $17,500. But you can see this is kind of how it works. So it all depends on how much entitlement was charged against you on your old property and then for the next house, again, it has to be owner occupied. So so when you're leaving, you can rent out, or it could be your vacation house if you can carry both properties, versus your new home. Which is, that you're buying. So yes, you can have more than one VA loan at the same time. Okay. All right, refinances. All right, refinances, you have your cash out and your streamline is available. You also have your VA interest rate reduction refinance loan, and requires no income documentation, no appraisal needed. It's very easy. And cash out loans, sometimes you can go up to 100% of the cash out, but it depends on the lender. Because it used to be it's 80% or some 90%. I have multiple investors, and I have ones that'll go up to 100% cash out. Okay, loan churning of VA loans, it was done by some mortgage lenders and was prosecuted by the CFPB for good reason. In response, some safeguards were put into place for VA cash out loans, for any kind of refinance loans. A VA loan cannot be refinanced for 210 days since the first payment. Okay, I've passed since the first payment and 6 mortgage payments have been made. So it's really more than 6 months. It's 210 days from the first payment. So if we're in August, so basically your first payment is, October 1st. So you use October 1st plus 210 days. So that's when you're eligible. And then, just give me a call and then I'll do the day calculation and see when you're in the window for that. And then any refinance from VA has to have a net tangible benefit, and cash out is not its own benefit either. So you need to pay off debt in order to increase your residual income in order to get that cash out to fly through underwriting. Okay? All right, loan comparison, FHA versus conventional. All right, let's take a look here. All right, let's go to... All right, this is my mortgage coach. So it's for a $350,000 purchase, okay? So FHA 3.5%, VA 30-year fixed, conventional 3% down. So you can see that the rates on VA and FHA are pretty good. FHA is slightly better, and then conventional, about 0.5 point or so higher than a FHA. And then for this one, in 1994 payment FHA, the VA is 1838, and then the conventional 3% down is 1995. But how can that be? I mean, they're putting down down payment on this one, and your VA is still beating them out. It's about $157 more. And the reason is because of that mortgage insurance. So you go to the more info tab here. I just assume $150 for insurance, $250 for taxes. Okay, but you can see this mortgage insurance, $236 on FHA, and that never goes away, by the way. Then you also have the conventional 3% down, but that'll at least fall off when the property appreciates. And the VA starts off with none. And the closing cost here. Upfront mortgage insurance premium here, but it's a big old funding fee on the VA. And if you're a subsequent use, that is a drawback. When you're looking at it, you see that number is like, oof, that's pretty high. But you can finance it, so it's definitely worth it. I mean, even in this scenario, it's high. That funding fee. At the end of the day, you have a lower payment, and you're only paying $10,000 out of pocket. This guy in FHA is putting $22,000 out of pocket. And the guy for the conventional is $20 grand out of pocket. So you're paying half of what those folks are paying, and your payment's better. So the VA, in my opinion, is the best loan out there. I definitely recommend it if you're a veteran to use your VA loan if you can. Okay, let's come back here. All right, the seller listing agent perception. A lot of listing agents out there, they have bad assumptions about VA loans. They assume that, the veteran's putting down no money, they're risky borrowers, the VA appraiser is going to crawl up and all of my attic and look at everything. It's like, no, they're not. And the statistics bear it out. The VA loans are the best performing loans, and the default lower than even conventional loans. Okay, we're in a kind of a crazy market these days, a lot of cash, a lot of property selling over list. And some sellers feel that veterans don't have the funds, and that's not true. So, if you're a listing agent out there listening, definitely take a VA loan. They're very strong loans, and we can get them closed quickly, no issues. Okay? All right, how to apply for a VA loan? Definitely give me a call. You shoot me a text message, the number here. Go to DempseyMortgage.com. Get your DD-214 together with your character service, just like I showed you. You get your certificate eligibility if you happen to have it, or I can run it down for you. You complete your application. Shop at a few lenders, a bank, a broker, and you get a loan estimate. Make sure that you're getting the best deal. And then what I always do is find your max purchase price you qualify for based on your income, and then we buy your new home. Okay, well, that's kind of it in a nutshell. I hope that was an informative guide. Here's some more videos on my channel that you might find useful. Thank you so much for watching, and I'll see you on the next one.